Morning, everyone. Welcome to this morning's edition of the MPC Markets Morning Call, 27th of April, 2027. New South Wales is a public holiday today for the Anzac Day weekend, along with a few other states, but the market is open. So we will plough on. Now, and we finished at record highs yet again on Friday night, just as basically the Philadelphia Semiconductors Index is really dragging this thing higher at the moment. Semiconductors really pushing the broader index and supporting it very much. The likes of Intel, Texas Instruments, real old school chip makers having absolute stellar days after their earnings, after the close, up sort of 18 odd percent. And we had the S&P close at a record high of 71.65, up 0.8%, and the Nasdaq at 24,836.6, up 1.6%. It was an 18-day consecutive sessions for the SOX index or the SOX Semiconductor Index, which is a record. It's never pulled together that many strung together that many consecutive wins in a row. But all this on the back of it's Schrodinger's Strait. The ceasefire is and the Strait of Hormuz both being open and closed, so no one really knows. Add to the geopolitical uncertainty, we had a lone gunman, taken down at the White House press dinner on, I think, Saturday night. There was a manifesto, etc. I haven't really gone into it in too much detail. It doesn't seem to be too many shots fired. I don't think it'll mean much for markets generally. Overall, what we're going to be looking at, I would imagine, is the earnings this week and a bunch of really large sort of central bank announcements from the Bank of Japan, the Bank of England, the Bank of Canada, the FOMC. We've got inflation numbers in Australia here Wednesday. We've got PCE numbers on advanced GDP on Thursday in the States, and 16 trillion in market cap of earnings to come this week, with Amazon, Google, Microsoft, Meta, and I'm sure I'm forgetting one of them. But anyway, Strait of Hormuz traffic overall is still very low to negative. To null and void, to nil. We've got this gas shock really climbing to now 31.5 billion. That's the number that it's going to cost the the consumer at the Bowser. We've still got troop build up as well, and we're at 57 days to normal supply. Brent crude was slightly lower, but still around the 95 mark. So here's your market map from Friday. Apple was unchanged. Most of the Mag 7 dragged this thing higher. Obviously the chip stocks, etc. You got healthcare and defensive names sort of on the nose a little bit. Tesla dragged itself a little bit higher, but look, there's no massive clear patterns there. Cybersecurity, sort of in the middle there next to Microsoft, and some of the software names had a little bit of a bounce back. And but overall, not much to really write home about when it comes to these. There were no earnings on Friday, and if you look in the bottom left-hand corner there, you've got Micron, AMD, Intel. Intel ended up nearly 23%. Quite an incredible run for what's been, one of the more poorly managed companies, and really probably only survived due to being the incumbent, or the only foundry chip maker in the US. But now it's starting to come back with a vengeance. Very good for the American people having an investment in Intel and backing it there, and obviously working with Elon Musk as well. So really on a tear. We've also got the likes of Qualcomm, etc., heading a little bit higher. So there's your indices overall. We're still in very strong buy territory for all the technicals everywhere except sort of Australia. We're a little bit, we're made up of a lot of big healthcare names, banks, and mining names, which haven't necessarily been doing particularly well. And I think energy, obviously, and a smaller tech sector, which we can't seem to get off can't seem to pull the optimism that the US market has on that. So crude did drift away a little bit. We won't see an open there. We're actually seeing an open sort of as we speak. Crude's opened up around about 1.6, 1.7% at 96. And Brent would be, well over that $100 mark there as well. We saw gold and silver, copper, and platinum head a little bit higher. They're like I said, they're sort of seemingly more jumping on the risk assets bandwagon. They're not as opposed to being a risk-off asset. So this is what we're going to be looking at this week. Amazon, Apple, Meta, Google, Microsoft. And look, the biggest tech stocks, excluding Tesla, because it's got such a massive PE, because it's all looking at forward things that it's going to be doing. The 5-year average is around about the 27, 28 mark in these things. And we're sort of sitting here at the moment around just under 20, well, just around the 25 mark. So this is forward PE, and realistically, they're actually relatively cheap here at the moment in terms of the 5-year average. So, and as we know with the US, it is designed for them to beat 80% plus of companies always beat. So the analysts are always erring on the side of caution, you can call it rigged, you can call it whatever, but whatever it is, if you should be an 80% chance of beating, and I dare say most of these will. There's some of them, they are the most covered companies in the world. Microsoft's been absolutely hammered recently. Google's been on a bit of a tear, Meta mixed, and so we'll be definitely looking at those cloud services from Microsoft and Amazon's, maybe some product releases potentially, or product updates from Apple. And then Meta, will just be hoping that there's not another disaster. They have already announced an enormous amount of layoffs at Meta. So that usually is taken quite well by the market. Markets don't care about people, they care about results. So look, we've got a few things early in the week, and then you've got some manufacturing data, some GDP on Thursday, and we'll basically have there'll be that Wednesday, Thursday period where we're going to get those big earnings, and then we've got the Fed on Wednesday morning, I believe. It'll be Thursday morning, Wednesday night, and then I think Apple will be in that morning, that Friday morning there. So, and Aussie, that's in US time, that calendar. So Aussie CPI is on the Wednesday as well. So that's going to be pretty key for the RBA. Advanced GDP numbers are going to be really key for the US. We've got Bank of Japan early in the week. I believe it's tomorrow. Then you're rolling into Bank of Canada, Bank of England, FOMC, and a few inflation numbers here and there. So, look, I would favour this market to probably stay fairly buoyant for the next, over the course of this week. There's too many things out for this thing to get belted. Everyone's seemingly bored of the war, and until we start to see those economic numbers come through. We did see consumer sentiment in the States hit a record low on Friday as well, at 49.8. I was surprised it's the record low. I would have thought that consumer sentiment numbers would have been worse than that at stages. But look, you do have this thing being the Strait being closed and the conflict going on, and the return to normal being well in the 2 months region now, is realistically going to hurt the market and the economic numbers moving forward. And I don't think there's a hell of a lot Trump can do to turn that ship around. Excuse the pun. So yeah, we're looking at this buy the dip strategy. It's for both retail and sophisticated investors. Essentially, you're putting down anywhere between sort of $16,000, $17,000 to get $100,000 exposure. Your entry price is the lowest Monday close between May 18 and October 18. which seasonally is a very weak period and reliably weak period in a midterm election year, a minimum of a 10% dip. So that's going to, help you buy a hell of a lot lower. And while we've got valuations, sort of flashing red for the broader market, and we're probably going to get some sort of, rally to the upside. If you're holding any index ETFs in the S&P or the FANG, etc., this is a great thing to switch to overall, because it's a 3-year period of the investment, and we all know that Trump's going to make sure that the market's going to head higher for the rest of his term. So scan the code, have a look at the videos, etc., and grab the PDF. And with that, this deal will close in roughly about 16 odd days. It's a really good, really smart way to play what is the most, every 4 years that comes around, the most statistically reliable dip in the market in the S&P, and that statistically reliable and consistent rally in the S&P 500 as well. So one of the better strategies to come out at the moment. And like I said, if you're holding existing ETFs, this is super capital efficient, and really is a bit of a no-brainer in terms of the maths overall, because and if you're not holding it, still a great investment. The S&P 500 is one of the more consistent yearly performers, particularly over the course of 3 years, and getting that extra leverage onto it is a great way to take advantage of that. So look, people, I'd expect a very quiet day on the Aussie market today, and I think the SPY was down around about 3 points. We're somewhere in the high 87s. But have a great day, and if you haven't listened to it, we've got really good feedback from our Bulls versus Bears podcast on Friday. We did a bit of a conspiracy theory episode around Trump, etc. So good one to go and watch. But enjoy your day. Enjoy your day off if you are in the States with a public holiday, and we will speak again tomorrow.
Feeling lost with investing? Meet Mosaic. Mosaic is MPC Markets' platform that turns confusing markets into clear, actionable guidance for your portfolio. Discover Mosaic today. Portfolio and trade ideas in one place for clients and subscribers, powered by MPC Markets.